We are live now and we'll begin the session. A very warm welcome to all our viewers to the 19th edition of Cedrus Knowledge Series, an initiative wherein we have one speaker each month speaking on a variety of topics ranging right from investing to well being. We will now play a short video of Cedrus Wealth Partners. For our 19th edition, we are extremely honored to have with us Mr. Swarup Mohanty, Director and CEO, MIRAE Asset Investment Managers India, and a member of the Mutual Fund Advisory Committee SEBI, as our esteemed guest. We will now play a short video to further introduce him. We look forward to having an insightful session with you, sir. Once again, a very warm welcome to all our viewers and our speaker. I would now like to hand over to Mr. Nilesh Bajaj to take the session forward.
Thank you, Unnati, for the lovely introduction and the video. A very good evening to all our viewers and good evening, Swarup, for being a part of the 19th edition of Cedrus Knowledge Series.
Good evening, Nilesh. Thank you so much for having me on the show. It's an absolute pleasure and honor to be part of such a wonderful thing developing from your end. So, more power to you.
Thank you, Swarup. Swarup, risk is something which very few investors actually understand. It's typically the investors are always running behind returns. We believe that we as at Cedrus are more as risk managers than only return generators for our investors. Uh, by design, actually, we believe that Cedrus that investment should be more of by design than by chance. Okay. So, instead of trying to take a chance on the markets, I think, our belief is that we can actually design a portfolio which would deliver returns subject to the discipline, which is, which the investor keeps. Uh, and basically, Swarup, it's been 2 decades, you have been in this industry and you've experienced innumerable ups and downs in the markets. Uh, and we would definitely like to learn more about risk from your experiences of 20 years. So my first question, Swarup, in fact, is basically okay. Before I start the questions, I would just for our audience, this is a moderated session uh, whereby we will ask Swarup our set of questions. In the meantime, if our viewers have any questions, they can post the same on the comment box. We will take them at the end of the section. Swarup, our first question is basically about investment behavior. The behavior keeps changing with different market cycles, and this is not something which is very new. In fact, we have been always seeing that there is exuberance where you should be fearful, and where you should be, you should actually where you want to go and invest, you become fearful at wrong times. In fact,
True.
they risk. Last year we have seen investors were all gung-ho about the markets. We saw maximum inflows which came in when the markets were almost at its all-time high, and we have seen a decent correction post that. Okay. So my first question to you is that citing this 2021, 2020 and 21 rise and 2022 fall, okay, which we have seen. We've seen a fall of about 14, 15% from the highs. Uh, what would you, how would an investor actually, invest? Means what would be your advice to them?
Nish, I think more than my advice, you summed it up very well when you said how you go about putting up your investment process. I mean, all of us start off as return chasers, but with investing and time and market cycles, we realize it's a business of understanding your risk. And the good part of that is, everybody's risk profile is different, and everybody's risk profile is correct. I mean, your risk profile and my risk profile, without even asking each other, I can tell you that will be different. And you are right in your place, I am right in my place. So, more you convert it into a science, and that happens over a period of time, it does not happen overnight, the better the portfolio strength becomes. Now, when you look at this entire last 2, 3 years, and let's go back a little and start the story with demonetization, that is when I think a lot changed for the investing climate or the investing environment in India, because there was distinct shift from, say, fixed assets to financial assets. The need for this financial assets sort of started post demon, and I'm just sort of saying from the figures that I see. But then came this huge event in our lives called COVID. Earlier in our school books, we would have read that it is before Christ and after Christ, but it is now before COVID and after COVID, and that will leave a permanent mark in all our lives. But what COVID did to all of us was we got enough time to ourselves in our houses to do a little bit of soul searching. And in that soul searching, obviously, we also got a great chance to differentiate between our needs and wants. Prior to that, we were doing a lot of spending in our wants, confusing them to be needs. But we led 2 years of our life not being able to spend anything in the want category, and yet our life was okay. So post COVID, as we graduate to normal life again, I see that distinct change in everybody's life. And I'm saying that with a lot of data around me, that people now have gone back and reworked their income expense statement. And with the help of people like you, have been able to put the investment need in the forefront. And that's such a welcome thing to see. Now, what you started off saying that, at a time when one is fearful, one should be fearful, one is actually greedy, and the reverse normally happens. But at the underlying, when you see, and I'm saying that from the mutual fund inflows, I see the change finally happening. People are reversing, and people like you who are consistently talking about it, and it being backed by the unfolding events happening and a direct impact on people's portfolio, is leading to a dramatic change. And I use the word dramatic change in their way they are approaching investment. So my advice, or my basic statement would be the same as yours. Look at building a portfolio as per your goals, and that is most important. I always say the star of anybody's portfolio is the goal, and the person who takes you to that goal is the rock star. And if anybody googles, it's very easy to form a portfolio. There'll be 30, 40 pages of how to build a portfolio. Build a
True.
portfolio. If it's a 20-year journey, I challenge somebody to stay put for 20 years, because it needs a lot of discipline. And when markets behave the way they behaved in the 2 years, your discipline, your entire mental ability is destroyed. Somebody who remains sane and makes it scientific, makes it completely unemotional. And let me tell you, that happens over a period of time, will lead to a far better investor. And in times like this, a better investor is born, because one
Absolutely.
gets to see the upside and downside of the market. One gets to relate to the risk of the underlying portfolio, and then come out of it and adjust one's own risk profile to the portfolio's risk profile. So it's a very simple thing. Don't look at markets, look at your portfolio more than anything. And if there's something bothering you about the portfolio, discuss it with Nilesh, and he will find a perfect solution to that portfolio. But from an investor perspective, there have not been better times for an Indian investor at this moment. Equity is looking good. Prices, which every fund manager will come and tell you that I want to buy a good business at a good price. The price is looking good. Now the government of India is 10-year is at 7.4. I give this example very often that my home loan is 6.7. 10-year GSEC is 7.4. Technically speaking, my credit rating is more than the government of India. Hence, it's a special situation. It won't last long. But at 7.5 or 7.4, there's a great opportunity at the longer end for debt investors. Gold still is looking very nice in this. When there is an issue with equity markets, gold comes to the front. It's your choice. It's your composition, but it's a time when one can consolidate and build a very strong portfolio for one's own self.
Absolutely. No, but in fact, one more problem which we generally have as advisors or fund managers is that we get inflows when we don't require the inflows. In fact,
True.
and definitely financial planning does help, but help investors, sail through the whole volatile markets. But then there is definitely this belief that equity in a good market, when they enter, they expect that you will get a year-on-year return. It will be a symmetrical return, whereas the market returns are mostly asymmetrical. In fact,
True.
one good part is that seriously, what you have mentioned is that we have also not seen too many investors who have actually have come and told us that we want to move out. We have lost money. I think it's more to set investor expectations right from the beginning. And if the
True.
expectations are set right, I guess there is nothing to worry when the equity markets are falling. My second question to you is, most of the, I'm sure a lot of people will ask you about, tell us about your good experiences with the markets. Markets के अच्छे बारे में हर time बोलते हैं, but I'm sure there will be some experiences, of dealing in bad phases of the markets. You have seen quite a few of them, and could you give your experiences actually uh, about deal? How did you deal with bad phases of the markets?
So I think this is a very interesting question because everything that you learn is from bad phases. I mean, I started selling funds in the late 90s, and then in the 2000, we entered into the first era of technology unfolding in India. And as a mutual fund seller, I was a very high conviction tech fund seller. And it's no brainer that it's going to be technology driven, and all this story which is playing out now after 20-22 years started then. So to catch it early, we sold those funds like there was no tomorrow. Okay. The conviction was extremely high. It was very simple and powerful story. But that was when, our first brush with, or our first experience of the downside risk of the market unfolded. I mean, the 10 rupees went down to 2 rupees, and we didn't know what hit us. And then that is when, I understood it was never about a return. It was always about underlying risk. And the more you understand risk, the more you communicate about risk, the better seller you become, or the better communicator become. I think from that day, I'm a fearless risk communicator of my funds. I mean, we just launched a FANG Plus, which is a 10 stock portfolio equal weight of US
Hmm.
disruptive tech. And I
Right.
instructed the team, forget the composition. First, bring out the risk of the portfolio. Let people know that this is at this risk. Returns and all will follow later. So I am a fearless list talker about my portfolio. I have to be absolutely clear in front of my investor and my partners that this is what they are getting into. And that was the first experience. I think the
Hmm.
second big experience came in 2008, 2009. The fact that, these large companies can get away, get out of the market over a period, such a short time was a shocker. I mean, some
Right.
of the names which exited the market were like unbelievably large names, and what unfolded also showed me that the upside and downside come together. and
Hmm.
and 2008, 2009, I was behaving like a normal investor, the greed and
Hmm.
fear theory. But
Hmm.
what subsequently happened taught me the virtues of holding asset allocation. I
Right.
didn't hold it then. That I
Hmm.
practiced in the COVID crash.
Hmm. Hmm.
COVID crash, I was a very, very confident investor, and I was waiting for the crash. Bring it on is
Right.
what I said. And I did allocate. And today my portfolio is stronger because of what I allocated at the downside. The same
Hmm.
thing I'm practicing again, because this is not going to come back in a hurry. I'm wishing and
Hmm.
praying that this elongated bear run takes a longer time so I can accumulate more units at a lower level. And I'm a
Hmm.
more comfortable investor than I was thanks to these two, three. I can go on, but due to time, I'd like to restrict it to this. But these
Hmm.
large events always take you very well, because when there is a crash, it comes with a
Hmm.
start date and end date. It is how you
Hmm.
behave within the start and end date will
Yep.
completely define your portfolio on the upside. And
Very
that's
true.
that's something which has made me a better investor.
Hmm. Hmm. No, and in fact, I think what you mentioned is that the biggest learning is during the bad phases of the markets.
Correct.
It teach all the arrogance which we have when there are big bull market rallies. And I remember there was a very big rally from 2003 to 2008,
Correct.
and investors were getting returns on a yearly basis of 30-40%, and
Yes.
it was as if there was no end to it. But all good things have to end,
Yeah.
and that is what I think the 2008 crash taught us. And
True.
hopefully, I think this year, this fall will not be that bad. But I'm sure this time the only difference is that there is the investor community is also been quite matured. They understand the behavioral aspect, and hopefully, I think we don't see a deep correction like what we have seen previously. Uh, my next question to you is, tell us one big mistake, which you in the markets, and how did you learn from that? Actually, there must be, definitely some mistake which you must have done, and how did you actually? What was your learning from it?
I think one, I'll cite two mistakes.
Right.
One, I think, was not starting early enough. I
Yeah.
started working at the age of 24. And
Hmm.
if I would have invested 500 rupees per month then, I would be financially free now. Because I didn't
Absolutely.
invest now, then the pressure of
Hmm.
investing for me has really grown a lot. Right.
Hmm.
The second learning was to avoid transactional investing and
Hmm.
graduate to an overall portfolio level investing, and that's something
Right.
which I learned through various mistakes of trying to take
Hmm.
tips from people, or getting into investments because somebody else is investing. It took me
Hmm.
some time to realize that if some investment vehicle is good for somebody else, it need not
Hmm.
be good for me. And 9 out of 10 times we get asked by investors which is your best fund. So now I
Right.
reply, do you need that fund actually?
Hmm.
And I
Hmm.
started learning how to ask that simple question: why am I investing before I get into it? So today I've
Hmm.
become very mathematical due to these two huge mistakes, because the pressure on investing just grew because I couldn't get in early in my working days.
Hmm.
Secondly, I've moved from being a tactical investor or looking for that best investment vehicle to more
Right.
what suits me. And now I'm a
Right.
very unemotional, mathematically asset allocated, Excel driven sort of investor. And that's helping me from an investment experience perspective. I
Right.
have a
Right.
fixed goal, and
Hmm.
I'm on track on that goal.
Okay, wonderful. Actually, so two learnings is one, start early, and second is have a strategic investment in place than doing a tactical investment. In fact,
True.
uh, our next question is, we at Cedrus, we believe that I think discipline among investors is more important than the smartness, which means trying to time the market and trying to earn that extra buck. In fact, to create wealth in equities. Okay. Uh, what are your thoughts about this? Actually, it's more in relation to what you have spoken, but any inputs you would like to give on this?
See, and Nilesh, finally, wealth creation is the amount of money you invest into the
Hmm.
returns you predict to the power of n, which is the time.
Absolutely. Hmm.
Most of the times, we are in control of the money. The only thing that we are in control of is the amount of money that we can invest.
Hmm.
Earlier, we used to time the market from a mistake perspective. Now, I
Right.
follow a very simple principle. Because I go to a fund manager to invest, I don't have the expertise to choose stocks for myself. I've
Right.
made life simpler. Choose a
Hmm.
good fund manager and follow the journey with him. So the
Hmm.
best time to invest is when you have the money.
Hmm.
Let Since I'm paying a fee, let the fund manager bother no when to buy, what
Hmm.
to buy. That's his call or her call.
Hmm.
But over a period of time, you realize that the focus of how much returns to get can be
Hmm.
mitigated by the time factor.
Right.
If you give more time to the investment, and please reflect on what I said of starting, not having started early and putting pressure on my portfolio now, is that the
Hmm.
more time you give the investment, you can actually do reach your goals at lesser returns. And
Hmm.
if you am able to reach my goal at lesser returns, then I can achieve my portfolio returns by taking lesser risk.
True.
I don't have to take undue risk if I have time on my side.
Hmm.
That's something which I'd like to leave behind. So we might start thinking that you can time the market, let's find the best investment vehicle, but over a period of time there is a
Hmm.
reversal to me. You are going to
Hmm.
get the return of the underlying asset class, maybe a little bit more, little bit less, but if you
Right.
give it time, you can actually mitigate the risk to match your own risk profile. If you are high risk taking and you have more time, you probably earn more money. But if you
Right.
want to go through a serious route where you reach a place where you want to go, then
Hmm.
time is a bigger factor than timing. This is most said in the market. There is a lot to read about it. But once you start practicing it, the actual biggest, factor of
Hmm.
compounding plays, and the power of compounding. Or if people want to just,
Hmm.
Google it up, read about the rule of 72, and it
Hmm.
is a phenomenal power, hidden power, which unfolds over a period of time. You can miss
Hmm.
anything, don't miss the power of compounding.
Absolutely. No, in fact, we do a lot of financial planning, and I think that is what gets in a lot of discipline to within our investors, because like what you mentioned in the first, as an answer to the first question, that I think the discipline will come if you have a goal in place. In fact, and that is what we try to do. But what is this is something which keeps happening. The long term definition keeps changing with markets. Okay,
True.
so market when it's in a bull market rally where you're seeing continuous rise in the markets, your long term definition changes, and as we get into a fall and a continuous falling market, it gets elongated. But what according to you is long term, where if suppose we want to invest in a large cap fund, okay, what would be a time horizon which according to you is the time versus timing kind of a factor which will be more
Ex-
comfortable?
Actually, it's the definition of the composition of the portfolio. Now, you look at
Right.
any company, to
Hmm.
build a company, it does take time, and your
Right.
fortunes of that portfolio is defined on when those companies will be at a level to share their wealth with the shareholder.
Right.
So long term will depend on how long your view is on any company to start
Hmm.
generating money. And no company can generate money in 2 3 years is a reality. So when you look at investing in large companies or any company for that matter, I mean, my basic barometer is, when you try to figure out when the equity returns, on an average of the category is, comes to no negative returns, and that's typically 7 years and above. So
Right.
at least, when you look at good markets on your side, please don't come into equity with investment horizons of less than 5 7 years. You don't buy a house for 5 years. In fact, you buy a house not to sell. Nobody buys gold to for 3 4 years. But this long term, short term discussions happen when it comes to this asset class. But as
Absolutely.
we graduate as investors, we will
Hmm.
start behaving like the way we behave to our fixed assets, which is you buy to hold. And then of
Hmm.
course you should review your underlying, and if somebody is not performing well, then you should make the necessary rebalance. But your
Absolutely.
commitment to the asset class has to be
Hmm.
similar to the commitment that you have to your fixed assets. And that's when you actually give yourself a chance to really build assets or build good wealth. I mean,
Hmm.
everybody will say they've built, I mean, generation wide would say they've made money in real estate. Nobody will
Hmm.
realize that it's a 20 30 year period.
True.
Probably I mean, today in Pune, if somebody would have bought a house in Koregaon Park, and the
Hmm.
value today without even checking would be known. But this discussion that we are having would be without even checking would be a 20 30 year horizon.
Absolutely.
Now, the thing is very simple: buy a good asset and hold it. Now,
Hmm.
I always find it very difficult to answer that, when we are behaving in the same way, we already learned how to behave in the fixed
Hmm.
asset regime. If you just
True.
replicate that behavior into financial assets with the
Hmm.
help of a good planner or an advisor who knows what assets to pick, then do the
Hmm.
journey. Wealth
Hmm.
creation can happen to the same level or maybe more. Of course, I can give examples where capital
Hmm.
markets outperform real estate and gold. But the
True.
key there is time. So replace that same behavior here. And hence, I mean, let's not talk equity below 5 years at least to start with.
I totally agree. Actually, this is something which we give a similar exam to all our investors. Example, when they invest in equities, in fact. And I think, the advantage of equity is also a disadvantage, because it is more transparent, it is
Correct.
more liquid. It becomes a disadvantage because whenever money is required, we pull it out from there. Okay. Whereas, the disadvantage of real estate is something which is basically illiquidity. That becomes an advantage when people require money, because they don't move out of real estate, whereas they will move out of equity or equity funds whenever there is a fund requirement because of the liquidity, easy liquidity
So,
available.
so well said. I would earlier say that the only person who makes money in equity mutual fund is the person who has lost his account statement or her account statement.
Absolutely. Hopefully, he's invested in the right fund.
No, see, any fund, I mean, look at it from perspective, I'm talking about the diversified equity funds.
True.
The returns would be there. Maybe somebody else would have earned more,
Hmm.
but on the average, the category average has delivered.
Absolutely, absolutely. So that was a wonderful, thought actually, and I think it's very much aligned to what we at Cedrus also what we do is we actually compare it with real estate, and we tell treat equity like real estate. That's when you will get your returns. In fact, coming to the markets, and this is a little technical, and I will actually if you could give your house views on
Yeah.
the markets have corrected by 14-15%, okay, from their peak. uh, and it's we have seen this in 2008 also, that when the markets corrected from 21,000 to 17,000, there was a lot of money which flew in, which came in actually, because investors thought ki, yeah, it's a good correction which has happened, and I think we were not expecting it to fall more, and then it fell to 12,000, 10,000, and you know what happened. But those were different times. There was a global financial crisis which had happened, in fact. Do you feel this correction has got, can be more deeper, or means, and this is the views we expect from MIRAE actually, as to what are your views that if today, if you investor has 100 rupees and he wants to invest in equities for 10 years, okay, how should he actually approach the market? And what is your expectation of, when this markets will stabilize?
So I think two, three things. I think this whole view of the market changed with COVID, right?
Hmm.
Let's face it. I mean, when you look at it in perspective, post demon to beginning of COVID, India was in practically a slowdown mode. If you look at
Hmm.
the market commentary before COVID, there
Hmm.
was so much of hue and cry about markets getting polarized, markets shrinking, 7, 8 stocks running. That was the
Hmm.
scenario. I
Hmm.
personally feel that COVID has been a blessing for India, and
Hmm.
it's changed everything from the underlying investing universe perspective. From being a
Hmm.
polarized market, today it's a widespread market for the fund manager. What
Hmm.
was so difficult to buy before COVID, today is a full blown value market for the invest
Hmm.
for the fund manager. Let's realize that. The second
Hmm.
thing that I'd like to leave behind is both COVID and
Hmm.
it was followed by a war are
Hmm.
huge, disruptors in nature from an economy perspective. When
Hmm.
you shut down your own house for 2, 3 years and you open
Hmm.
it after 2 years, you also know there'll be a huge maintenance bill waiting for you. So when you
Hmm.
and this is the first time that the entire globe has been shut down for almost 2 years from an
Hmm.
economic activity perspective, right? When it
Hmm.
is opening up, the entire universe has changed and the entire demand pool has changed, everything has changed, and then you follow it up with a war, it just compounds. The good
Hmm.
part of all these things is whatever is happening is due to a known reason. It is
Hmm.
not something which is a bolt from the blue. And as we start getting into this whole situation into a more known near distant, we will start reacting very well. I mean, in the movie Jurassic Park, the best statement that's a learning for life for me personally is that life always finds a way. I mean,
Hmm.
let's give a live example. At 100
Hmm.
rupees and above petrol,
Hmm.
5, 10 years ago, governments would tumble.
Hmm.
There's not a whimper because people know why the petrol is at this level. But at
True.
100, it's not a significant price rise, a huge price rise, right?
Hmm.
what has happened in the US at this moment, we are talking about inflation figures which have, with this, probably this generation has not seen.
Hmm.
And please understand, at the bottom line, Warren Buffett in 2008-9 had said that the world trades in dollars.
Hmm.
So when the US sneezes, we will catch a cold is a reality. And that day has still not come. So that is why this
Hmm.
uncertainty. Some of the
Hmm.
data points on inflation and their underlying price rise is unheard of in the last 10,
Hmm.
15 years in the US. And that will
Hmm.
have a cascading effect on the rest of the world. Where we
Hmm.
stand out, and here is where is the clincher, because the best part of India is we consume our own produce.
Hmm.
We are not an import heavy country, or we don't depend on them for our livelihood. And if you
Hmm.
check data points at this moment, and whatever I'm going to say after this is purely based on this, if this was not there, nothing would be there. You look at life around you, and you look at data points, whether it's from health insurance
Hmm.
to buying of airline tickets, to your malls in your city, to
Hmm.
buying cars, to GST collection, any data point that you see,
Hmm.
there is a strong revival on each data point. The
Hmm.
point is, there is a certain demand pull at the underlying.
Hmm.
How long it will last is something which we have to check, because if this elongates more, there will be some fatigue to this data point. But at this moment, there is
Hmm.
a strong revival of the Indian economy. And please understand, we are 2 years post COVID. The
Right.
advantage which we have of a low base in COVID is now beyond us.
Hmm.
Corporate earnings are on a revival.
Hmm.
Yeah. And they are not on a low base. The low base was 2 years ago.
True.
And when you look at these things, we bring two things. A house view, you ask for a house view. House view is very simple.
Hmm.
Post COVID, you cannot take away the sort of impact on smaller balance sheets or mid-level balance sheets.
Hmm.
While it's a clear advantage to large companies, not only large companies, but large automated companies, because they have the
Hmm.
cash reserves to fight through
Hmm.
this or survive through this. So
Hmm.
it is a kind of a flight to safety from our perspective. If we today manage around 100 rupees in equity
Hmm.
in MIRAE asset, nearly 64, 65 rupees is in large caps across
True.
our portfolio.
Hmm.
We are saying that there is a distinct advantage. There was this big discussions of large cap, losing sheen and all that. We completely
Hmm.
disagree with that. In fact,
Good.
this volatility has given that inefficiency which large cap managers come back with
Hmm.
their play again, because these large businesses are
Hmm.
available at some good prices which they were looking for. So from a fund manager perspective, he or she has two things to do. One,
Hmm.
can buy, if they have inflows, can buy flow stocks which they had bought at an average, which you can do in your portfolio. Secondly,
Hmm.
some of the stocks which they had missed for whatever reasons in the past, they can inculcate in the portfolio. And due to this demand pool, the number of stocks in play have widened to the number of stocks that were in play post COVID, pre COVID. So
Hmm.
just be a little watchful of your mid and small portfolio, because many businesses might not revive the way they were
Hmm.
earlier. So that's where one has to be a little watchful and select good managers, unless that's your job. But
Hmm.
please understand, it's a good time for large cap funds, and especially that large flexi cap, whatever, that is back in
Hmm.
play. And
Hmm.
if one is a little watchful, and see, there's a lot of money which has gone out from the Nifty 50 stocks.
True.
Sooner or
Hmm.
later, today, post COVID, barring Ireland or one or two countries, India is growing at a far
Hmm.
better rate than the relative emerging markets. So the money will come back. When the money comes back, they will
Hmm.
start buying Nifty stocks first before they go into
Hmm.
any other stock. So the upside
Right.
is there, visible.
Hmm.
The
Hmm.
war will continue, but as it continues, the
Hmm.
economies will graduate to accommodate the war, and will
Hmm.
start building businesses and economies accordingly. So
Hmm.
as it goes into a known territory, let's face it, the Fed hike was 75 basis points,
Hmm.
last one. A
True.
phenomenally high rate. Okay.
Hmm.
But our markets didn't flinch because markets were expecting a rate hike.
Right.
But one thing I'd like to leave behind is again something which I had said earlier. From a
Hmm.
debt perspective, you are getting some fantastic yields at this moment to lock in. I would
Hmm.
really request you not to miss those rates, because these rates will not be there for a longer period. Suppose
Right.
somebody has a view that it'll go to 8. the 10-year.
Hmm.
Fine.
Hmm.
But suppose it does not go to 8, 7.5 in itself is a very good yield, which, I mean, 1 year ago, if I would have said, you would have taken it.
True.
So if it goes
True.
to 8, you can average a little bit more, but don't miss these yields at this level. So it's a good time for an investor, both on equity and debt side, with a little bit of caveat of being a little watchful on the mid and small space, because the easy money is behind you. From a house, we
Hmm.
were bullish on banking. This has been a 1.5 year earlier call. Some of people in the
Absolutely.
market are giving that call today, but if you check, our banking fund was launched 1.5 years ago, and
Hmm.
that remains, because that's not participated in the rally. And if Indian economy were to revive, the banking has to revive. It's a very simple sort of thing. But otherwise, we play through our diversified fund.
Okay.
But as an
Hmm.
investor, I want this period to continue a little bit more so that my SIPs can accumulate more money. I'm a
Right.
salaried person, so when my next salary comes, I should be in a position to buy some more
Right.
equities at this level. And plus,
Right.
I'm not missing
Hmm.
these yields in the debt side.
True. So, what I could understand is that you invest in tranches over a period of time. The longer,
Yeah.
the better. But if you have a bulk amount also, it's better to invest in tranches in
Yeah, so
equities.
it's each one to his own. See, I get
Right.
salary, but suppose
Right.
your view, Nilesh, is the war will
Yeah.
last 8 months. Suppose, just for
Hmm.
discussion, you have 10
Hmm.
rupees divided by 8, buy in 8 tranches. Suppose you feel
True.
1 year, then divide it by
Hmm.
12. As simple as that.
Absolutely. Absolutely. And definitely what you mentioned, and I think that is something which is which we were not expecting, because I remember last year a lot of investors invested in the SDL portfolios at a yield of 6.2 and 6.3, and the
Yeah,
same SDL portfolios you're getting at 7.5, 7.6 actually.
yeah.
So it's a wonderful opportunity in debt also, in fact. Now,
And Nilesh, to
coming
those
to
investors, I'd like to say that in the
yeah,
equity, you figured it out that, okay, if the market crashes, let me buy some more and average. Somebody
absolutely.
bought at 6.2, why not buy at 7.5 and average it out? Increase your yield.
Absolutely, absolutely, very true. And you don't have too much opportunity in debts. Means comparatively, if you
True,
see,
true. These
uh,
opportunities don't come up often.
yeah, and with the
This we are talking
RBI,
about 2027. So 5 years,
mm,
this yield is
mm,
is pretty decent.
absolutely, along with the benefits of indexation which your mutual fund
Correct,
provides.
correct. Yes,
In
you
fact,
can't take
yeah,
away that.
yeah. So, coming to the next question actually, and this is more to do with MIRAE. I remember when MIRAE had come into the Indian markets, everyone was, what is MIRAE all about, in fact. And I remember even we didn't recommend MIRAE for the initial 2, 3 years. And the reason was that it was a little herd company from Korea. And, we were not very sure as to, how it'll perform. But I think work speaks more than anything else. And you have quite a few funds in your bucket which have given consistent returns over a period of 10 years also. So something like a Mirai emerging blue chip fund which has been there since such a long time, and it's been consistently giving returns. In spite of the AUMs increasing, and then you have other funds also in your bucket. So I think that is something which is my next question all about. That at Mirai, what is your process to manage risk in equity funds specifically? And again, as we understand, seeing Mirai, we know that definitely risk is something which is given more weightage in your portfolios than just trying to chase returns. But how do you manage the risk in your portfolio, and what are certain things? What are your processes of managing portfolios in equity
Yes,
funds?
actually, yeah, this is the most important question if you ask me from MIRAE asset perspective.
Right.
See, is my personal opinion. I'm just speaking as Swarup Mohanty, as an individual who's a observer of the industry. See,
Hmm.
every fund manager who reaches that level of fund management is a stock picker. Otherwise, he or
Hmm.
she will not reach there.
Hmm.
Between a good fund manager and a great fund manager is risk management.
Right.
Somebody who is able to manage risks and stick to the processes ultimately survives over a period
Hmm.
of time. And that is how the consistent return comes. I mean, you are talking about emerging blue chip, which is a large and mid cap fund.
Hmm.
And with mid cap, you don't associate the word consistency.
Right.
But you've associated the word consistency with that portfolio, which just speaks for itself. And
Mm,
honestly, I'm so fortunate to be representing that fund in the market.
mm,
And
mm,
my working with Nilesh Surana, who's our CIO, and I have
mm,
now been working for 11 years with him. And
mm,
working with him has been a learning, and a
mm,
learning of risk. And
mm,
every time I ask him this question, you have such high conviction on the stock. Why is it only
mm.
2% of the portfolio? And he'll tell me one answer. It's not my money, it's the investor's money. It's a
True.
consistent answer for him. So when you
Mm,
have a fiduciary role in your, and let me tell you, I'm very fortunate to be sitting on this chair with a fiduciary role in
mm,
under my belt, is that to make money for people who already know how to make money, there cannot be a bigger kick in life. But
mm,
this what starts as an investment return discussion
mm,
graduates eventually to an investment experience discussion.
mm,
That's the journey. And our aspiration is to give good investment experience to our investors. That can happen if the investors come in and have a more consistent way of returns in their portfolio. For that, you have to form very, very strong processes internally. Your funneling, it starts with the funneling of stocks. There is a gang of analysts, and let me tell you, each analyst is a specialist, and that's true for all fund houses, not us. Now the analysts will funnel the fund, and there is then their the fund managers and analysts come in, and what they form
mm,
is an investing universe. Now
mm,
suppose the investing universe is say 150 stocks, then
mm,
all the fund managers can buy stocks within this 150 stocks. It does not go beyond 151. If the 151 has to happen, it has to again follow this stock. It's not that a fund manager likes a stock overnight, can take it. It doesn't happen that way. It has to take
mm,
this funneling route. Secondly, we are fully invested as a fund house. We don't take cash calls. We don't time the market. The best
mm,
time to buy is to when you have the money. So when you get money, we buy. If you track our portfolios, it's never a 2% cash is a lot of cash for us. We
mm,
feel asset allocation happens at your end. If you've given us buy this asset class, we will buy the asset class. What it
mm,
does is it catches the upside of the market completely. If you
mhm.
And it was not very relevant this time because the downside and the upside was so sharp that all the funds were fully invested and all the funds in the industry caught the upside, and that's why every investor in the market was very happy. But if you go
True.
back to 2008 2009, when it was a little elongated and the returns, the upside of the market, the J curve came after some time,
Mm,
funds which were left performing were only the fund houses which were fully invested. So
mhm,
this, while theoretically we say that timing the market is very difficult, a lot
mm,
of people expect equity funds to carry cash. It's
true.
not possible to time the market. So we take that out of the equation. And if it's a 14-year track record, it has seen enough ups and downs of the market. If you are
Mm,
saying the returns are consistent, means there has to be some science behind this concept of remaining fully invested. The
mhm,
third part is the diversity of the portfolio. Our job as active managers is to beat the benchmark. That is why
mhm,
we charge a fee, right? That is the fundamental job. Our job is to give returns, to aspire to give returns above the benchmark. So the benchmark is in play. We don't
mm,
deviate much from the benchmark in our overall allocation. We can take sectoral calls which can deviate from the benchmark. We can take stocks calls which can deviate from the benchmark weightages. But we
mm,
don't typically blank benchmark stocks as a style. The
mm,
third most important part, which I feel, and this is where it differentiates, and this is my learning after watching them, is that they are very mathematical in their uh, which stocks enter which portfolio at what weightage, and at what weightage at a target price. Don't
mm,
not to wait for tomorrow and to clean up the portfolio if your target price is met. Okay, just to give you an example, suppose we have a very high conviction stock. I don't think it will enter the portfolio at more than 1.5% of the portfolio. And this is where my discussion and my learning is. I would always ask them, boss, you have
mm,
such high inflation, take 3%. What is wrong?
mm,
And then again, that
mm,
answer would come that
mm,
it is not our money. If we
mm,
are entering at 1.5, 2% of the portfolio, that
mm,
means we would always be sitting in front of you with 50, 60 good stories under our belt. That is how you
mm,
become 100%.
mm,
So we are this very diligent, bottoms up stock picking sort of portfolio constructor. What I
Hmm.
take comfort, and that is why I've become a confident equity seller over a period of time, is that
Right.
whenever I ask them about the markets, they tell me, irrespective of market condition, we'll give you 50, 60 good stories. Don't worry. So,
Hmm.
but if there is an upside, and at 4.5, 5% of allocation, no stock would be 4.5, 5% on purchase. It would be on
Hmm.
valuation. And at that
Hmm.
level, trust me, the fund management would be selling the stock, irrespective of what the market has a view on that. So to
Hmm.
do it
Hmm.
systematically in a disciplined manner, saying this is easy, what I've
Hmm.
said, but they've been
Hmm.
continuously doing it for 14 long years. And if they
Hmm.
stick to it, and that is
Hmm.
where the discipline plays out, and that is why the consistency plays out. You can make
Hmm.
mistakes. There have been enough mistakes in the past, but when you make mistakes, is restricted to 1.5% of the portfolio, which
True.
can be mitigated. The other
Hmm.
good part which has happened thanks to people like you is we've had consistent inflows.
Hmm.
So, it's also helped in
Hmm.
buying stocks at good prices, sometimes at highs also. But these levels, when we are consistently net sales positive, it also
Hmm.
aids the fund management in buying stocks at some great prices. So the faith that people like you have on us in and giving us money consistently is
Hmm.
something which I cannot deny has not helped the portfolio construction at all. But at the end of the day, it is
Hmm.
about this risk framework which plays out and track us.
Hmm.
We've debated only twice, where we had taken one stock in 2008 9, and that was kind of a cash call, and we took one, I think, 2013 14, that was also kind of a cash call, because we will
Right.
not take cash. So, but
Hmm.
otherwise, 4.5, 5% is a lot of allocation in our portfolio, barring those thematic or sector funds where some stocks are
Hmm.
above that in the benchmark itself. But on the
Absolutely.
diversified fund,
Hmm.
we remain truly diversified. We
Hmm.
don't take very concentrated bets, and that is what has played out over a period of time, and that's become our style.
Right. No, wonderful. Actually, we have been observing as advisors also that I think, risk is paramount in your portfolios. Than managing risk is paramount than just earning returns. And I think that is more to do with the fiduciary responsibility which you carry, and that's what is actually seen in your portfolios also. In fact, if I ask you, which is one dark horse in your, the in your basket of funds, which apparently you feel, is not, people are not looking at it, and you expect that it has got a potential of giving a great return in the future. In fact, anything what you would like to disclose? Any dark house in your schemes? Because I remember, people keep talking about emerging equities, large cap. Those are the typical funds where the money comes
True,
in.
true.
You know,
Yeah,
we recommend a lot of consumption actually. So
yeah,
MIRAE
yeah,
consumption is something
yeah,
which we have
absolutely.
taken since a long time. But I'm sure there will be a lot of fund houses which are ignored for schemes. Sorry,
Yeah.
and which you feel is a dark horse, but the money is not coming in. People are not putting money over there. So would
So,
you like to
no,
give your?
I agree with what you say, and I understand what you say is that, when there is the large cap and emerging blue chip is sitting with that kind of track record, the other
Hmm.
funds, and there are that many funds one can buy from a fund house. But
Hmm.
typically, we had a tough time saying that, our mid cap is good. Please
Hmm.
look at Ankit Jain. He's a great mid cap stock picker. But,
Hmm.
they would say we would want to be with Nilesh, who's the
Absolutely. Absolutely.
CIO and the more predicted one.
Hmm.
But Ankit
Hmm.
has proven that he,
Hmm.
if not better, he's as good in the system. He's probably one of our better stock pickers within that gang. When we
Right.
launched the healthcare, there was absolutely no recognition of healthcare, but it doubled money in 3 years.
Hmm.
Similarly, if I were to pick two dark horses at this moment, one would be the banking fund, because
Hmm.
in 3 4 years, it is at a level where the healthcare was 4 years ago, right?
Hmm.
It's not participated in the rally, not just mere banking fund. We
Right.
would try to be better than our competitors, but banking
Hmm.
in general, if you can allocate some on the tactical side, it can add a little bit of sort of kicker to the overall portfolio returns from here on. Our aggressive hybrid, because people have not taken well to and have gone more to BAF than the aggressive hybrid,
True.
But it's been a very, very sort of straight line return, and it's a steady fund at this moment, if
Mm,
I were to ask. And some person told me, which I sort of agree, because your debt can lock into these kind of yields and your equity is buying good
mm,
valuation. Why not?
mm,
The aggressive hybrid is in play now. So I
mm,
sort of concur with that view. But
mm,
broadly, all our funds, I'll stand by all our funds, and it's what suits your portfolio is more
mm,
important than what I say. And
true.
you be the judge. Our job is to give you a good, strong portfolio that we will do.
Wonderful. And in fact, I think, you've always had two stocks or two mistakes, everything in two.
Oh, that's a coincidence. I didn't realize that.
No,
Uh,
this is one question which just came up my mind. It was not a part of what I was going to ask you. But you have been in the advisory committee of SEBI, actually, the Mutual Fund Advisory Committee, and with all compliance. We just want to ask you is that is the fund manager's job getting more tighter with regulations? Okay, and would that lead to underperformance because of so many regulations on rationalization of schemes and the universe of stocks which they can buy within each scheme, and tighter regulations? Do you feel it's going to be a tough job for a active fund manager, and that's the reason why you're seeing so many passively managed funds come up in the last 1 or 2 years?
no, it's the question of the hour, and
Hmm.
see, ours is a fiduciary role, and
Hmm.
our job is to manage somebody else's money. And
True.
I feel the more the regulation, better for us.
Hmm.
So I welcome all sort of regulation, but somewhere if it enters the portfolio domain, then it does lead to what you are saying. But we are still not there, because if you look at the active funds and
Hmm.
the portfolio allocations or the stock underlying stock definitions have been very clearly made.
Right.
Pre this categorization of funds, everybody had their own view on what is a mid cap. There was
Hmm.
no standardization, right? So now it's a
Hmm.
standardized industry, and it is actually apple to apple comparison. So that's brought a lot of sanity to the overall business. But
Hmm.
what the other side, which you have to understand about categorization of funds, now on the active side, there are that many funds you can bring, and the ideation of that funds have also been defined. While on the
Hmm.
passive side, wherever
Hmm.
there is an investable universe, you can create an index. And on that
Hmm.
index, you can create a fund. And through
Right.
factors, you can actually have multiple forms of that same index. So the
Hmm.
ideation is unlimited on the passive side. So
Hmm.
that is why you see globally a lot of passive funds come. But the
Hmm.
success of the passive fund then is a way of managing or being true to that index, providing liquidity to the investors, running the fund with less tracking error, and of course at an affordable cost, which the low cost brings about because
Absolutely.
it does not require research. The research
Hmm.
and everything has been done at the index formation level.
Right.
So as the markets become transparent, as the markets become more mature,
Hmm.
active management is always under pressure, right?
Right.
Because with transparency, the whole thing of going and finding a stock alone is
Hmm.
defeated.
Absolutely.
When you do with all the research in a transparent market, you think you reach the stock, there are 20
Hmm.
other people already there. So the price discovery, which could have happened in an inefficient market over a
Hmm.
period of time, reduces. But with that reduction comes the stability of the market, the sanctity of the market. So there are two sides to every story.
Hmm.
Yes, with the transparency, and not due to regulation, due to increasing transparency of the market, active
Hmm.
managers will be tested, and good talent will be separated from a not so good talent, right? that's
Right.
that's a given from here on. So
Hmm.
it is not about large cap funds, it is about the manager now from here on. And the
Right.
key or the science of your job now changes from who is a quartile one performer to who can possibly beat the benchmark. That's the dramatic
Absolutely.
change that will happen on the active side. We back
Hmm.
ourselves with our abilities to beat the benchmark. Yes, the job is not easy. It never
Hmm.
was.
Hmm.
But you have to then upgrade your skills accordingly. But the beauty of Indian stock markets, and thankfully due to this volatility, the inefficiencies are back. The investor and you are in a very sweet position because there is enough talent in the
Hmm.
active management in part in our industry to come and give you alpha. At the same
Hmm.
time, there'll be good product managers on the passive side which will give you some exciting stories.
Right.
So the investor going forward could be spoiled for choice.
Hmm. No, and so Swarup, I think the regulator is also playing its part in seeing that the risk is in managing risk. In fact, in
Hmm.
portfolios, I think that
True,
is
true.
why these regulations have come in. In fact, so
Yeah,
that the risk on portfolios, what the fund manager takes, is within the framework which is laid by them. In fact.
true,
So,
true.
wonderful, Swarup. Actually, we have spoken about your role in MIRAE, your role as the as a part of the advisory committee with SEBI, as well as your experiences with risk. In fact, with such a large experience which you have. Now I'll pass it on to Unnati, who has certain questions from the audience.
That was an extremely insightful and intriguing session, sir. Moving to the audience Q&A, the first question from the audience is regarding private equity investment. What are the risks associated with PE investing, and how much can one allocate towards the same?
I see. Actually, when you look at the flow of money over a period of time, the flow of money moves to places where the alpha generation possibilities are higher. I mean, when we had great upside in real estate, people would stick there, and the reason it moved to financial assets was the possibilities of that were higher on the financial asset side. But when you look at the formation of a company, there are two sides to the company: pre-listing and post-listing. Now, we mutual fund guys are post listing when everything about the company is already in the public domain. But through private equity or in the pre listing space, you are entering at a time when a lot of the information is not in public domain. Hence, those analysts, those fund managers carry a very different skill set to people who carry a post listing sort of skill set. Of course, I just said that with markets maturing and becoming transparent, the possibilities of alpha shrink. When they are not transparent, the chances of a good private equity manager going in and finding a good company ahead of its time are always there. But please understand that in this pursuit of alpha generation, comes with the risk of underperformance also. That is true for active funds. That is true for private equity. So again, I bring back to this basic thought of mine that you cannot paint the entire industry or space with one brush. It's about identifying a good private equity manager. And if you get a good private equity manager, of course, the chances of alpha generation far superior there than here because the price has not been discovered yet, right? But choosing the manager is very, very critical, and that's something which one must focus on more than the underlying. Then the manager will go and find your 7, 8 stories.
Right, absolutely, sir. And my next question to you is, sir, as fund managers, what are your views on cyclical stocks and sectors? How can one identify such cyclicals? And what is the risk attached with such sectors, investing in such sectors?
I think it's a very, very good question because let me just differentiate that, sectors are cyclical, themes are more secular in region. So if you are looking at mitigating risk, graduate to themes than sectors. I'll give you an example. Suppose Nilesh and I talked about our consumption fund, which is almost 9 years old, or probably almost in the 10th year. See, when we started consumption, then consumption was mostly FMCG. Today, consumption is a full blown portfolio. Check the portfolio, it's a diversified portfolio. When we started healthcare 4 years ago, it was primarily pharma. Now it is graduating to a full blown sort of portfolio. When I started selling mutual funds, our portfolios used to read banks. Then it was bank financials, NBFC, sorry. Then it was bank, NBFC financials. Now it is bank, NBFC financials, fintech. That is how a sector grows to become a theme. And theme are more secular in nature. Theme can run for 15, 20 years at a trot. So theme sectors are cyclical in nature. Themes are not. Themes continues to build. So to mitigate risk, it is better to identify themes rather than sectors. Yes, if you have to identify sectors, then you have to be very micro in your nature, get into the deeper side of each sector and catch the cycle before it starts. And probably come with a target return which can enhance your portfolio overall return, give you the kicker on the satellite side, which you need, right? If you have that skill, please do it. Like, our view is banking is a good sector to be in, but at the same time, banking, financials, and fintech is a good theme to play out in the next 3 4 5 years. Say when we launched the healthcare fund 4 years ago, we had said typically healthcare will graduate. We had no clue that COVID will happen. Healthcare will play on, but the valuation now is so attractive that the upside is far better than earlier. So it is not very difficult to identify which theme is not played out. But the key would be to again bring in that word of discipline, come into that theme when it is not played out. And the broad 4 5 themes that run an economy, right? And when it is on the downside, catch the theme. My only advice would be, be a little strict on when to get out. And if you have come with a target return, on the day that return is met, just leave the theme and leave. Don't get greedy after that, because on the day that theme will look far better than what it did, and the chances of your redeeming will lessen. But don't do that. Come with a target return. It's a better way of investing.
Right, sir. That is it from our side, sir. On behalf of Cedrus Wealth Partners, I would like to thank Mr. Swarup Mohanty and MIRAE Asset for making the time to grace this event, and to all our viewers for tuning in such large numbers and making this event a success. We will return next month with a new topic and a new speaker. Until then, stay healthy, stay safe, and happy investing.
Thank
Thank you
you
so
so
Thank you,
much
much.
on
Swarup.
our behalf for having me. It's been such a pleasure and an honor to be with you. Really appreciate.
Thank you, Swarup, and wish you a safe journey. And
Yeah, thank you.
you have some wonderful time abroad.
Thank you. Thank you.
Okay. Bye. Thank you.
Bye bye.
Okay.
Bye.
Bye.